Welcome. So this is the Strategy Tools and Consilience Ventures webinar on why tokenizing sweat equity. It's fantastic that you can join us. Please chat your name and where you're logging in from in the chat box and what you'd most like to get out of this discussion. So I can see some of you are writing now from Germany, from Istanbul. We have some heavyweights in the field of venture capital, scale-ups, and working with private equity in front of you today. With more than 120 years of collective experience as business leaders, consultants, academics, investors, board members, and entrepreneurs that have done this, the team with you today have addressed issues, failures, and challenges that every one of us as stakeholders faces. So we started this discussion together by asking one key question, and that was, what will it take to increase the success of scale-up ventures? Whether you're working in corporate venture capital or an executive, a board member, an LP, a GP, an entrepreneur, an advisor, or even thinking to start your own fund, we all want to know what it takes to make scale up work. And today we are very fortunate to have with us Kevin Monserrat, who is the co-founder at Consilience Ventures and an entrepreneurship expert at the University of Oxford in the United Kingdom. Rick Rasmussen, who's the co-developer of the Scale Up program, an industry fellow at Berkeley in California, and an expert venture advisor to Silicon Valley. Christopher Rangen, who's the CEO and founder at Strategy Tools, a partner at Engage Innovate, and an advisor to more than 100 scale-up firms. And I am Scott Newton, managing partner at Thinking Dimensions and a director at Strategy Tools. We hope you leave this session with some new ideas on how you can break down the barriers and successfully participate and enable scale-up growth. And whether you're leading, sponsoring, advising, or investing, you'll have some tools and some new technologies that can help you for a more successful future. So with that introduction, I'd like to turn things over to Rick. Rick Rasmussen, welcome, and we look forward to learning from you about scale-ups.
Great. Thank you, Scott. Thanks for that nice introduction, and greetings from Silicon Valley. Good morning to everybody from here, and good afternoon, good evening elsewhere in the world. I'm going to take just a minute and do a setup to talk about the problem. The subject here is why tokenize sweat equity and why. So let's take a quick look, and I'll turn it over to Kevin right afterwards. I'm pulling some slides here from the Scale Up Coach program, which is something that we released out of Strategy Tools over the course of the last few months. And we often start off with the scale up journey. I think this is an interesting look at the world because it basically says that scale ups, startups in general, can start in a number of different ways. You can start off with an idea that forms a team that has an idea. And there are a number of ways to pull things out of research labs, establishing a problem first and then a team, and then a problem. Or you can simply just start off with a problem in general and form a team. The Scale Up Coach program goes through some of these test cases and talks about which ones work better than others. At the end, they all work equally well as long as you get to the next step, which is to identify a true problem to be solved and that solution for the problem. And that comes through user validation and interviews. We take that next step. Once you've identified a true problem to be solved, a realistic solution that is much better than what's out there today, and the market that's large enough to care about, we then move through the journey through additional customer and market validation into product market fit. This is key. This is a scalable, repeatable sales process, and this is the point at which things typically become interesting for professional investors. And once we achieve product market fit, a company, a scale up, can take a lot of different directions. And the directions are highly dependent upon the team that not only is executing, but the team behind the team. So you can go all the way from a high growth express path to IPO into, on the other side, either slow market uptake, the valley of despair, and potentially close down. So really, it's all up to a lot of the people here that are on this call that perform these tasks. So reflecting back to what's out there in industry, this is often called the Steve Blank methodology, the customer development method, and simply states that it's super important to get to each one of these gates. A lot of companies fail because they don't have something that's vetted and a product worth building. Companies fail because they haven't got a repeatable, sustainable, scalable sales process. And at this point, you're looking to create customers and grow. This is the point of scale up. This is the point at which investors, professional investors, become really interested. And then engagement means that you can go through and engage rapid and scalable, repeatable growth, month on month, high percentage points, to the point where you're actually building a true company. So a lot of people are involved in this process. Again, another slide from the Scale Up Coach program where we go through and we talk about venture capital and its structure. And most of you here are familiar in general with this, which is a series of limited partners that provide funds to a venture fund. That fund then uses general partners, venture partners, associates, and others to go ahead and make investment in individual startups, and money is made when those startups and scale-ups exit. So what does it take? Who else is out there? Well, in addition to the core professional, paid general partners and venture partners, often, and the best venture capital firms engage others such as advisors for the scale-ups, mentors for the scale-ups, coaches for the scale-ups that are bringing those scale-ups all the way through that process to get to that product market fit and get to the point where they're able to go ahead and scale. And it doesn't stop there. There are professional development experts that work with individual CEOs and team members, because many of these individuals have not run or started a company. Down here is a scale up. You get industry experts that talk about the overall scope of where things are headed and what should be done. And you get subject matter experts as part of your mentorship team that are specifically working on team finance, team marketing, team sales, team operations, and all of those things. So I put them outside of the general box because they are. Organizationally, they are not full-time people that are working in that venture capital fund. So this is why we developed the Scale Up Coach program. And this is not an advertisement. It's just to say what's available out there to those people that are on the outside and are looking to develop their skills and potentially monetize those in the scale up world. So it is a full-blown program. Take a look at strategy tools. We'll talk a little bit more about this later on, but we're super excited to offer this to the world. And it is intended for all of these people sort of outside of the core, but also within the core itself, because honestly, even venture partners, if you're able to do due diligence and select an investment, you have to manage that investment all the way through. So Scale Up Coach, a whole series of tools, great to take a look. So what we've been talking about is team, and investors select a board of directors, manage a CEO, may have some co-founders, but and they hire an executive staff. You have some service providers like attorneys, accounting firms, PR firms, recruiters, and others that are professionally paid. But typically, in order to be successful, a scale-up will engage a whole series of advisors. So how are those advisors compensated? Everybody else here has a known and well understood compensation structure. So what these people, these advisors, are providing is essentially sweat equity. They're working, sweating, but how do you go ahead and compensate them? Well, here in Silicon Valley, a lot of times it's, well, hey, you're my friend. Can you help out here? Can you do this? That's fine, but it doesn't buy groceries. It doesn't pay rent at the end of the day. And it certainly doesn't build wealth. So either, can you do this for me, please? Can you do this? And then there's this idea of karma points and paying forward and so on, but that only goes so far. You can pay these advisors cash, but scale-ups are inherently, just by nature, short on cash. You could provide stock options, but the tricky thing about options is that you have to buy those options. And so if you're an advisor, you may end up paying money out of your pocket in order to advise somebody to get stock that might be worth something in the future. And you can provide stock grants, but that's stock grants in the company, individual company you're advising itself. So my story is that back in the dot-com days when stock grants and stock options were the common way of compensating advisors, I received a number of different stock options across the board, cashed out a few of those, received certificates, which was cool. And I actually, and over time, many of those companies did not succeed. So in my folder, and I was looking for it in advance of this talk here, but one day I was in a mood and I pulled all those worthless stock certificates out of my drawer and I pasted them on my bathroom wall, of all things. Well, in a couple of moves, I've lost those certificates. It doesn't matter, they were worthless, but you can get the idea in that equity in an individual startup or scale up has a high percentage chance of failing. And so you've put in your time and you've put in your effort, and you may not be able to realize that compensation that you so richly deserve. So this talk is basically on how to solve that problem, on how to compensate and pull into the fray all of those people that are helping your startups and scale-ups. So there's my setup. Happy to answer additional questions as we go through, but what I'd like to do is to introduce Kevin, and with that, let's start the main event.
Thank you very much, Rick. I am now going to share my screen. Hi, everyone. Kevin from London. It's very good to be here. Thank you, Scott. Thank you, Rick. Thank you, Chris. This is this is something I'm deeply passionate about. It's about entrepreneurship. We are all about entrepreneurship here and helping the next generations to solve the world's biggest problems ahead of us, which is why it's so important to understand how do we help companies to take off with less or fewer dependencies on money. And hopefully we're going to be talking about this in the concept of tokenizing sweat equity to develop growth. Before I really kind of dive in, I'd like to share a very short story with you. I was at Microsoft Accelerator for just about 4 years, and I was very lucky to work with many entrepreneurs, typically companies that were going to Series A. So typically companies that were turning over below £1 million, typically companies B2B and with huge tech requirements, huge development needed in order to create a product that would scale, because usually they would sell to banks, or they would sell to hospitals, or they will be operating in a regulated environment, and that is very, very costly. And of course, no offense to any investors in the call, but nobody likes to pay for lawyers, and no offense to the lawyers as well, but nobody really want to put the money where it's very difficult for the entrepreneurs. So what I've observed at Microsoft is that some companies, in fact many, were actually using sweat equity or paying equity, some of the mentors in our program, some of the advisors, and this is how I kind of started to realize that there was value locked into the sweat equity, and then very rarely this value was realized. So if I ask you to kind of be innovative and imaginative here in this context, what happens if you can really remove the need to raise money, right? So if we look at what are the needs of entrepreneurs, right? They need people, they need publicity and profit. This is oversimplification. Rick has given you far more details, but I think that's the bottom line here. And effectively, if we really kind of try to look at what's broken in the process, is that at the end, to get publicity and profit, we need people. And then when you need people, you usually need money, and you need to pay those people, or otherwise they're not going to help you. They're not going to produce. They're not going to advertise. They're not going to create something that you can sell and make a profit of. But usually, especially even more in Europe, where most of the LPs and as a consequence, the VCs are more conservative, they are asking startups to get traction before being funded. And that is a real problem because, of course, to get traction, you need people. So you're back to square one. And this is effectively what is broken here in this concept is how do you get traction without people and how do you get money without traction? And we believe that this is the real opportunity here by tokenizing sweat equity is how can you get surrounded by the right people at the right time so that you can build something that gets traction, that gets attention, and that gets funded, and so that you can hire more people and retain those people. So one of the things that most entrepreneurs, especially first-time entrepreneurs, underestimate is the power of momentum. It is very easy to try to raise money when you have done this many times and then when you know exactly what you are after. But when you're doing this for the very first time, what you need is really kind of to be very creative. And what you really what most first-time entrepreneurs don't realize is that they have the power, they have the equity, they have the invisible ends. And this is what's exciting about tokenizing sweat equity. It's because if you really use your equity as money, and we'll explain what that means later on, then all of a sudden you get the momentum and then you can push up to the point where you get funded. So effectively tokenizing sweat equity, it's about turning equity into money. It's as simple as that. And in tokenizing sweat equity should give you cash and expertise. Two reasons. Experts, typically the experts like you have the panelists on the call today who have 20, 25 years of experience. I'm not looking at making anyone look very old in this call right now, but when you have 20, 25 years of experience, you're not very interested in working for $500 a day. You're rarely interested in working for $1,000 a day because what excites you, it's the people you're working with, it's the intellectual challenge, and it's the reward, it's the big reward at the end of that journey. It's not to pay your bills. And of course, if we manage to tokenize those shares and then they become valuable, then it will become an asset of its own that will attract investors and therefore cash. So the very simple explanation of why we should tokenize sweat equity, if you haven't understood it, is that we need to reduce the risk of those companies. We need to increase speed, performance, and the valuations of those businesses, because you would not believe how many companies get too much money too early in the process and they never get to raise more money when they actually need it because they are too diluted already. And that is creating companies that end up plateauing. If you're not familiar with the name, it's basically when the sales and the profits are not increasing. So the third element of this, it's about creating liquidity and trust. Because why liquidity and why trust? And why do they come together? Because effectively, liquidity, it's what makes the thing turn the wheel. It is basically, it is the exchange, it's the trade, it's the bartering. It has to be liquid. It cannot be illiquid. But what it has to be trusted, simply because at the very beginning of any relationship, trust is the foundation of that relationship. And this is why blockchain is very interesting, because blockchain, it's probably one of the very best technology out there to create trust and to create liquidity. And of course, as Rick explained earlier, you have the network. Even if you are coming out of universities and you have a couple of good ideas and some friends, you may not have all of the best access to all of the best mentors or to the best advisors. But what you can already do is you can already look at effectively mechanism to reward those people, and usually you'll end up paying sweat equity, but you don't want to give them sweat equity of your own company simply because you don't want to have those people on your cap table, because you don't want to give them the same rights than your investors, and then you don't want to have 20 or 30 lines on your cap table when you have not raised your seed or your Series A. It just creates messiness on cap tables, and investors don't really like that. So this concept of tokenizing sweat equity should tackle all of this. Now, there are different schools of thoughts in in cryptocurrency, in crypto, and in blockchain, in the blockchain world. It's a vast world, right? Blockchain, it's not one mindset. Tokenization, it's not one mindset. So what I try to do here is I try to show you kind of the four main one that I could think of, which I think can shed some lights as to how we can think about creating liquidity, because again, we don't think there is only one way to do it. You have the crypto fan, you have the crypto like, you have the people that are very much into Ethereum and Bitcoin and other crypto assets and alt assets. And of course, those people, they love the liquidity, right? But liquidity comes with risk. And for entrepreneurs, we don't want to create too much liquidity and too much volatility, because this means risk. And for entrepreneurs, we're taking enough risks. We don't want to take more risks. And then that's the reason why too much liquidity can be bad. Now, when we were exploring about different concepts within Consilience Ventures, we started to think about one token per startup, and then we actually didn't really like this. There are various reasons. Some are more technical, some are more business reasons, but at the end of the day, we didn't fall in love with the fact that we wanted to create one token per startup. If you think of how the stock market works today, and the legal burden and the pain, to say the least, of the compliance and in reporting that those listed companies want to do, you don't want to enforce this on early stage startups. It is going to be too heavy, and yet you need the data of every single startup if you want to create one token per startup. And also because the VC world, it's a world of signal. And then if you start to have too many people selling tokens of one startup, it really sends the wrong signal. It is very difficult. It is very rare that the startup is going to basically get the money that they are looking for, because everybody wants to sell. And in finance, everybody likes liquidity only because they have other investment opportunities, but otherwise you keep what you like and you sell what you don't like. Now, because we've been co-investing with a couple of funds, and every time we have to introduce Consilience Ventures, some VC managers, some GPs are asking whether we could come up with versions of our technology to tokenize their funds. That's not our model, to be clear, but simply because we think it's too limited. We don't want to create another token for 20 or 30 startups. It's not where we want to go. What if we create one token for all? What if we really tokenize sweat equity worldwide and we create the currency for entrepreneurs? That's what we're really passionate about. And this is very much the reason why at Consilience Ventures, we thought about creating something completely different, which is tokenizing the entire portfolio and then build an evergreen portfolio, which is founder-centric, fast and agile. It should be 100% focused on the customer needs, which are the startups in this case. And as I explained earlier, if you have the exchange, the resource exchange in the middle, then what you have is 100% alignment between startups, experts, and investors, which is really rare. We can have a whole webinar on alignment between investors, between investors and experts, between investors and startups. Again, this is a very complex subject. Let's not spend too much time on that, because the whole point here is to connect the world. Connectedness, it's probably one of the most important criteria. Once you have all of the tools that you can find, from strategy tools, but from others as well, what you need is to be connected. Your network is your net worth. And if you can manage to build a strong network globally of people that love and like your product and also have a skin in the game, they will help you to soft land. This was things that we were doing at Microsoft. It is very difficult to implement at scale, but you get the idea. You're a young startup coming out of the UK borders or wherever you are around the world. And if you're going to the United States or wherever you want to go, if you have a business developer, a lawyer, an accountant, and a PR agency that loves you and are shareholders, indirect shareholders of your business, they're going to work for you. They're going to help you. So this is kind of the whole idea. But when we were preparing this presentation, I went a bit too far in terms of programming Sweat Equity. So what I hope I did, I hope I kind of brought everybody on the same page here so that we understand the fundamental of what it is. But what's under the tokenization, it's smart contract. And smart contract is something very, very exciting because effectively we know that if the startups are hitting milestones, we are going to automate or systematize the financing of those companies using smart contracts. And we're going to move away from waterfall fundraising to sprint fundraising. For those who have an engineering background, or for those who are familiar with the waterfall concept when it comes to software development, we now all about agile and sprints and so on. The same thing is going to happen the way to the financing of the startups in the future. I'm personally convinced about this. And it is going to be more complicated in terms of data, in terms of transparency. We are going to have to be more transparent, but in the end, it is going to be to the benefits of the companies, because it is not enough. It is not good enough that the founders are spending 6, 9, 12 months to try to raise money. It is not good that companies are failing because they don't find money. They should be failing because they don't find customers, but not because they find investors. And if they hit milestones, they should be funded. So this is the whole concept of basically tokenizing shares using smart contract to help companies to raise tokens against milestones, and then stop going to demo day, stop going to incubators and accelerators who are only good at putting, for some, not all, only good at putting companies in front of investors at the end of the program. This is about helping companies being very, very much entrepreneur-centric and making sure that they help to move this world. So I wanted to have a very, very quick kind of share with you some of the limitations of tokenizing Sweat Equity, some of the complexity, where the complexity is right now. So I mentioned volatility earlier. I think we all get it, right? You don't want to raise money. You don't want to, believe that you have raised £1 million that is worth £500,000 3 months later, or even sooner. In terms of governance, so long as you're touching blockchain, so long as you're touching smart contract, then you have to be pretty clear about what governance you want to adopt. And there are most companies are testing, learning. We are just scratching the surface of governance. You've heard of DAO, decentralized autonomous organizations. There will be others. But governance, it's at the core of what we do, because so long as you're using protocols like blockchain, you're running some sort of a democracy. And UX, it can be a bit surprising to talk about UX, but you wouldn't believe how difficult it is for people to understand that blockchain and tokens have to kind of enforce new tools to use in most cases. And there are a few tools, there are a few wallets out there, but so long as you start to have tokens, you are responsible for those tokens, and nobody's going to manage your passwords for it. And it is actually quite surprising how most people are still struggling managing passwords online, and blockchain comes with another layer of blockchain management, because nobody can retrieve your private key, nobody can retrieve your seed phrase. And we have to be responsible. And that's why investing in UX is going to accelerate the use of blockchain. So just to conclude, the key benefits are for all. This is not only for the experts who are going to make more money. This is not only going to be for the startups who are going to be rising with less pressure on their cash flow and work with 100% aligned experts. This is not only because the investors are going to take less risks by investing in companies that are properly supported by the right people right at the beginning, and not only once they have raised a few millions. It's for the entire ecosystem. It is about stopping wasting time and innovation, and it's about creating more successful entrepreneurs and create bigger companies, bigger than the companies that we're seeing here, especially if they share their profits and their risks through Sweat Equity. On that note, I would like to introduce you now to Chris, who is going to take the next step. If you are interested in hearing more, I'll be more than happy to take any questions at the end of the meeting.
Well, thank you, Kevin, and I'll follow Rick's example here. This is really interesting stuff, really. And I think one of the things that Rick and I was really working with in the scale-up coach development was simplify the whole fundraising process, simplify the development process, and what you bring in is really next generation thinking. So I want to have a couple of questions. So Kevin, first question. We have a gentleman on the call today who's based in Switzerland. His name is Amin, and he works with startups and scale-ups all around the world. He advises accelerators and VC funds. How would he go about using this? Like, how would Amin in Zurich get started? What are the first steps that he would do?
This is going to sound like a sales pitch, Chris, but there are no one that we are aware of that have pushed the model as far as we have. There are variations. There are emergent competitors, I would call them, or emerging competitors, I think. But it is extremely difficult in both technical, legal, because nobody's done this before. So if this is someone that is interested in basically building incubators, accelerators, and VCs on the top of the technology to tokenize sweat equity, would love to talk to them.
Super. And I also see from the questions, Scott, that we got multiple questions both in the chat and also in the Q&A here.
Yes, Chris, we have quite a few different questions. And actually, I'd like to lead off with one, Kevin, that someone's asking from a startup's perspective, how is paying in tokenized equity different from paying in cash? And then they follow this and say, why should I, as a founder, take tokens and how are they valued?
I love it. Those are great questions. It is our bread and butter. What we've observed is that, as I said in the presentation, there are a number of successful entrepreneurs around the world, exited entrepreneurs, people with 20, 25 years of experience. Their motivation is not cash, and they don't get out of bed to work for $500 a day. And what they get out of the bed for, it's purely to make big money, big wins in the long term. And what cash doesn't do, it doesn't give you the alignments, because you'd be surprised how many time wasters there are out there pretending they can work with startups, and they say they're going to work with startups, but the truth is that they have never worked with startups before, or they have failed with startups. And sometimes they are a very good salesperson, but it's that I've seen it at Microsoft. I've seen it in other incubators and accelerators. We are in a job where the problem with the startup industry is we are too transactional. It's about the deal. It is not about the success of each other. It's about the deal. How much you pay me, and then I will help you. And my only motivation, and I know some, and I don't want to sound too generic here, because I know some people are doing incredible job for cash. I'm obviously not denying this. What I have observed is that when people are effectively 100% aligned, there is a concept that most of you must be familiar with, which is called skin in the game. If you have not read the book from Nicola Nassim Taleb, Skin in the Game, read it. It's all about skin in the game. If you have people who have skin in the game, they're going to make better decisions that are in your interest. If you pay me $100 to give you some work, I will give you enough so that you get your value for your money. But if you gave me 100 or 1% of the success of my task, then I'm going to be pushing, because I'm a competitor. I'm going to push it, and cash won't do that. So from a startup point of view and from an expert point of view, it's the same thing. It's about skin in the game. It's about being aligned. It's about winning together. That's the reason. So why would you take Sweat Equity as a startup and how they are valued? this is something also deep. I'm very happy to have almost a second webinar on valuation of digital assets. In fact, I'm happy to drop you and to drop in the chat a whole webinar we did on the valuation of digital assets, because it's uncharted territory. There are plenty of things out there. There are plenty of school of thoughts. What you have to do is you have to do as much realistic as possible. In private equity, in venture capital, we talk about fair valuation. It's about that. It's the very foundation. It's fair valuation. How much do you think is it worth? And you never get it 100% right, but it's the same thing that an investor buying equity in your business, right? Whether you're worth 3 million or 2 million, it's the same thing. It's at the end, it's not right. It is an hypothesis, right? It's what I'm prepared to pay. That's what it is. And it's the same thing for the tokens. There is an appreciation, there is a proxy, but there is no science here until we build the data and then we scale it globally, when hopefully we're going to be in a few years.
Well, thank you, Kevin. That's a very detailed answer. I have another attendee, and they're asking, how will tokens reduce impact on my cash flow, as was mentioned in the presentation?
Awesome.
Do we swap our equity for tokens like cash, or
yes,
how does this work?
That's right. Exactly. Good question. Thank you so much. Yes, you swap your equity like cash. So, for example, you need £100,000 of expertise that you know you're going to pay in Sweat Equity. If you are valued at £1 million, you issue 10% of your shares, and you get effectively 100K of tokens in your wallet, and that becomes your currency. So it is that simple, and there's obviously no more complexity around this. Then you're free to trade. The benefit is you only have one entity on your cap table, as I explained earlier, and of course you don't. You're free to pivot, because you don't want to. The problem when you sign a Sweat Equity, I've given you some examples I've seen, but if you agree to give 1 or 2% to someone, to an advisor, for example, and you have a contract with a vesting period, what happens if you decide to pivot? Then you are still going to give your equity to that person because you have a contract with that person, because it's unlikely that in your vesting schedule, you would have said that if in the event where we pivot, I'm sorry, we don't need you. So you lose those equities. Whereas if you have those in tokens, you are agile, which is what you want as an entrepreneur. Now, why is it cost saving? Is because you wouldn't believe that sometimes companies, they come to us, they are raising seed, and they are paying some people 5-7K a month, and then I'm very surprised, because I know those people are worth that money. I'm not questioning this, but I know how sensitive I am with cash when I run my own business, and I think that spending that much money, at least in the UK, and maybe in the US there are different school of thoughts, but you really try to be as cash conservative as you can. So what we're proposing to those companies, we will say, well, those people are worth seven grand a month, but instead of giving them away 7 grand a month of your cash, why don't you give them half of it in cash and half of it in Sweat Equity, so that you're all of a sudden, you're extending your cash flow by some month. If you're burning less than 100K a month, or for example, after 7 or after 12 months, you have literally extended your cash flow by 3 months. So this is the power of basically using Sweat Equity to keep rewarding people for what they are worth. We're never questioning the value of the people that you have on your team and your advisors. What we do is, how can you basically achieve more milestones with the same amount of cash?
That's so cool. I'm going to combine a couple of questions together here, one coming from Switzerland, one coming from Israel, and they're asking, do you have a secondary marketplace so that entrepreneurs, are there preemption rights? Are the tokens tradable? If so, where and how?
Yeah, the short answer is that we've created all of the network and the marketplace to trade those tokens. So those tokens are exchanged against services or cash. And an interesting fact is that we have now founders who, once they understood the mechanics and the new logic coming with the tokenization of shares and of the portfolio, they ask, if they should really sit on £1 million they just raised, or if they should just buy tokens, and then buy tokens, put this money there, keep enough cash flow for the next quarter, and then sell enough tokens to pay for the quarter onwards, because of course the token value appreciates. And this is what's exciting, is because when I've got companies, this is back to one of the question earlier, when we've got companies, we're telling them, do you know how much your cash is going to be worth in 12 months? They're going to tell you, yes, it is what I've got in my hand today, minus the the deflation and or the inflation, depending. Well, anyway, so effectively what the token does is it grows with the company, it grows with the portfolio, it grows with your success. And one thing that actually I'm always surprised how bad I was when I was starting my first companies 5 or 6 years ago. I didn't think about equity management well enough. And what happened is that I realized that I was trying to raise 24 months of cash flow. I always thought, well, let's raise 24 months of cash flow, or let's try to raise 18 months. But as a young company, every 6 months, I'm a new company. Every 6 months, I'm a completely new company. I'm a new beast. I've got new people on board. I've got new clients. I've got new milestones achieved. So why the hell would I raise 24 months of cash flow when I know that the state of my company will have changed at least 3 times or maybe 4 times? So that's the exciting bit here, is that the tokens are following the performance of the company somehow. Not only one company, the entire portfolio, that's for sure, but at the end, it follows you one way or another.
This is great. I have someone else following on with this, and they're asking, if I'm an advisor and I've obtained tokens, can these be exchanged for tokens with other advisors, or how would I make this work?
I'm not sure I understand the question, Scott. I appreciate that you're translating. So do I get that right? So I've worked for a startup. I now have some tokens. How do I turn them into something, or is it the question? So
this is what they're asking.
So again, here, I can only talk about how we did it within Consilience Ventures. If people are, and I encourage people to do, other people, if you have technical capabilities, if you have legal capabilities and so on, try to do it yourself, because this is amazing for the entrepreneurship world. I'll tell you how we did it at Consilience Ventures. We are not saying that we have it 100% right. We know that our model has its own limitations, but our tokens distribute 100% of the profits. I'll give you an example. If you own 1% of all of the tokens in circulation, you receive 1% of the cash distributed at any startup, at any exit event. So you receive cash. So you can wait for cash coming immediately to your wallet, proportionately to the amount of tokens you own at the time of the transaction. Therefore, the more you earn tokens, the more cash you receive when there's a startup exit. Same thing for the investors. The earlier you buy into those tokens, the more tokens you buy, because of course the token value appreciates, or at least is expected to. And you can sell them on the second time. You can sell those tokens in the marketplace from investors looking at buying. And as I said, we are sure that it will be, the time will come where our companies will use their cash as basically buy CVDS and hedge the depreciation of the money in one first, and second, increase their purchasing power. It will happen.
Excellent. Well, thank you. A question now from South Africa. They're asking how scale-ups can accelerate in places where capital is more difficult to come by. So we know London, we know New York, we know Silicon Valley, we know Israel are pretty popular. But if an entrepreneur, for example, is in parts of Africa, that might be more challenging.
Yeah, so I'll start by saying, I'm sure Rick will echo this. necessity is the mother of innovation. And what you have in those regions, South Africa and other countries, what you have is you have amazing entrepreneurs. You have people that are working really hard and extremely talented, and that's all you need. And that's where these tokenization mechanisms remove the need to have as much capital, because capital is not only good. This is a lie that we're telling ourselves. This is the lie that you see on LinkedIn, on TechCrunch, and all of the publications. People who are raising new rounds every time they celebrate, they should actually celebrate. I don't know if they should really celebrate, because at the end they lost shares in their companies. I've never seen Microsoft or Steve Jobs claiming that they raise more money. That's not what they care. They care about securing new customers, building new product, generating new revenue, creating your new revenue lines. This is a lie. We're lying ourselves if we only want to raise money. What we need is to create something people love and make profit. This is far more exciting. So I'm very, very enthusiastic about how this technology can be applied in other markets who are less hot than places like London, Silicon Valley, New York, Boston, and Toronto, and so on and so on. Because at the end, the talents are there.
Yeah. And in fact, that leads on to, I've got a couple of questions coming in on how this could work, for example, in social entrepreneurship, or with someone's asking about offbeat business models. But I think what they're really talking about is the social entrepreneurship concept and how tokens might help in that area.
Yeah, I don't make any difference anymore. I think there are some. I think this technology can be applied to every single market, every single business model that you like. So if we were, for example, to create a new token only for backing social entrepreneurs, we could do it, and it wouldn't take so much time to do that. We're not sure that it's the right time, because as much as I can sound confident here, we are the first to walk in the snow, and there's still so much to learn about what we're doing, and we prefer to take the right steps as opposed to try to run before we walk properly. So we are very much looking at getting Consilience Ventures right, and then there's a long way to go, because it's a Pandora box once you start to remove the need to raise money, or as much money as needed. And when you start to program the money, it becomes super exciting, and we prefer to focus on one project for now.
Yes, absolutely. Another question coming in from Tel Aviv, and they're asking, how do you make sure the value of the tokens are aligned with increased company valuations? And they're saying, are the tokens secured versus cash, or how is this mechanism working?
Yes. So effectively, the way there are steps in terms of new valuation models, and we are at ground zero, if not -1. We are doing like any VC right now. We value the token the same way that any VC would do. So we are at ground zero. We're not even using the data we're capturing. We're not using any macro or micro data. We ground zero. But what we know is that the more data we capture, the more accurate we can be. And we believe that we are going to, one of the IP we are developing, it's called dynamic startup valuation. And this is where we want to get to, because effectively, if we start to be dynamic, why do we, if you look at all of those, I'm not going to do advertising or publicity for those big data players, they're making enough money. But what they sell you is they sell you static data. They give you how much money was raised at seed, and how much money was raised at Series A, and how much was raised at Series whatever, but nothing in between. Yeah, as if nothing has happened in the life of the company in between, which is why I think which is where we think, especially our data scientists are very excited, is because what if we start to understand what happened between those rounds? Yeah. And this is the exciting bit, because if you start to see what happened between those rounds, then you're probably going to be able to anticipate the next valuation of the company more accurately. And this is where there is big money to be made, because in finance, information is money. So if you have information, then you know what the price of something is. And this is why the big players are, the very, very big players are doing really well. I'm not going to name any of the largest asset managers around the world, but they make their price, right?
Right.
They're sitting on trillions of dollars of value, and they make their price. We just guessed.
Now I have a question coming in from Versailles in France, and they're asking, within a deal, how can I protect the value of my tokens? And generally, how did the security of the tokens work?
Okay, so you never protect the value, you can never protect yourself against an event there. I mean, this is private equity, this is private market, risks happen. I've had one VC friend who was invested in a very good company that was doing really well. We're talking about 100% monthly growth rate, and the CEO passed in a car crash accident. You never protect yourself against those things. You have to admit that there is a level of uncertainty, and you just have to live with it. If you're not prepared to accept uncertainty, you shouldn't work with private companies and early stage companies, because the risks are everywhere. So one thing that you can do is you can try to understand what level of risk you can take. I'll give you an example. We have some experts in our network. They have cash requirements more than others, and what they are doing is they are thinking about how much time can they invest per week. And they only do that. They stick to that. They need an amount of cash that comes at the end of the month, but they know that everything else, they can do it for sweat equity. It's basically an alternative to a pension fund. And hopefully there's no lawyers in that code, or no one is going to bite me for this. But how do you start to build your future? By basically earning effectively the value you create in your customers, and that's pretty much where that comes from. So you're protecting yourself against the pension fund. And if some of you are like me, fan of a YouTube channel called Real Vision, you will go to Real Vision and you look for pension time bomb, and you'll be amazed about what's going on right now. How are we going to be paying, all of us, in decades, when there's going to be more people retired than more people working? These are real problems. No government talks about. We're not saying that we're not claiming we're saving this. We're not claiming that we're solving this problem. But one thing is for sure: if you start to do 1, 2, 3 days a month, investing your time over a few years, you're going to do well, because effectively you are going to be exposed enough so that you have the right level of diversification in your portfolio. And the right level of diversification in your portfolio, believing it or not, it's according to INSEAD. Those are not my words. If you listen to INSEAD's the research they've done is that you need to have 500 companies in your portfolio if you really want to reduce the return dispersion. Everything below, it's a bet. And of course, some are lucky, and then we always hear those lucky stories online, and it makes us feel bad. Why am I not getting those kind of returns? Because this is luck. This is not predictable.
Yeah, it reminds me of the people who like horse races and they only tell you when they win.
Exactly, same thing. People talk about their success, never about their failures. So
I've got time for one last question, and then a few people have also asked how can they contact Kevin. Kevin will be sharing his contact information. This will be part of the presentation that we send out following the talk today. But kind of this last question, where a lot of people are going, how many companies will be in the Consilience portfolio?
Over what period of time?
Yeah, I don't have a time frame, so you can answer the way you want.
So if you give me no time frame, I'll tell you that we're creating the currency for entrepreneurs, and we'll have more than 1,000 companies in our portfolio in 10 years' time. And that's our ambition. That's the team vision. That's the network vision. We have vision tunnel on backing 1,000 companies. It is not as many as incubators and accelerators. Some of you will have seen that Incubators and accelerators are backing many more companies. YC, for example, has backed 2,000 companies over the same period of time. We're not an incubator and accelerator program. We don't take companies by bench of 20 or 30, take 5 or 7% in each and hope for the best. We are providing tailored startup acceleration, and then that is the reason why we cannot reach the same volume than incubators and accelerators. It's because we're not talking about accelerating companies for 3-6 months. We are very much looking at being a partner over a very, very long period of time, so long as it's sufficient for the business to be successful. And of course, we'll have failures because that's the part of the market we operate in. And we're very, very humble with the fact that effectively, no matter how good our technology can be, no matter how wise some of the concepts we think we have put together are, effectively, at the end of the day, we are helping founders to do better, but there is no magic wand. There's still risks, and we have to be very humble about the fact that some of those companies will unfortunately go under, and that we have to be with those founders even if they fail.
Fantastic. Well, thank you. This has been such a stimulating discussion, Kevin, and there's a lot of rich material to think about here. As you mentioned, we probably need another webinar to even touch on this. I just want to turn over to Chris now to share a couple of thoughts, and then we'll close out. We're about 4 minutes to the hour. So, Chris, would you like to?
Thank you very much, Scott. So, I was reflecting back on what you were talking about here, Kevin. The modern VC industry as we know it really got started in the early 60s, and then it really took off about 20 years later. And we find ourselves at an interesting space and time where we're really trying, globally, early stage investments is booming, speed to IPOs, the value creation through IPOs, the increasing digital avenues that you're presenting. And as Rick and I was working on the Scale Up Coach program, we are really trying to equip people with the right tools and insights to navigate this landscape globally. So in the Scale Up Coach program, we cover a lot of these elements, and we interview experts. We talk to VC funds. We analyze a lot of real life cases, and I was just thinking that there's such a steep learning curve for people all around the world to get really to the mastery level of what you were talking about. And just like you're showing us today, Kevin, the speed of innovation led by people like yourself is really, really happening quickly. So I want to take the opportunity to extend an invitation to everyone to be joining us to continue working in this field. So by joining the Scale Up Coach program, you get access to a large number of real life case studies on early scale-up companies all the way up to IPOs. You get a chance to really work with real life scale-up companies and the challenges they face. You'll get a chance to meet in different formats real life investors, and most importantly, get access to really powerful visual tools developed by Rick and myself. And on top of that, we have people like Scott, we have people like Kevin, who's coming in and just expanding the community and expanding the knowledge base. So I hope that all of you on the webinar today really, number one, get in touch with Kevin to follow up, because Kevin, I'm a fan, and that I really believe in this. And second, join Rick and I with the Scale Up Coach program. We do have an invitation for all of you to sign up today with 25% discount code. But I think the biggest call to action is really to go check out Concierge Ventured. And I hope that you guys will be as excited as we have been, as we've had a chance to learn both with and learn from Kevin. So Scott, back to you.
Thank you, Chris. Thank you, Kevin. Thank you, Rick. It's been a very stimulating discussion. I hope this was as valuable of a use of your time as it was of ours. And please check out Tokenize Ventures, visit us at Strategy Tools. And it sounds, Kevin, like if we can get in your diary, we're going to have to do a follow-up webinar, if that's all right with
I'd be happy
everyone.
to.
Wonderful.
Thank you so much, everyone.
Thank you, everyone. Have a great afternoon or morning, depending where you're calling in from. Bye now.
Bye.
Bye-bye.